fund management, of course, has some basic rules which lead to long-term portfolio success. So do these same rules apply when investing in Africa? Tonight we're looking at some methodologies employed by the Pioneer Fund, a fund which focuses on investing in Africa. And of course, as I said, it's co-manager here with us. So a warm welcome to you, Godfrey. Thanks for joining us today on WealthQuest. I mean, looking at African markets, certainly a solid year last year, and they continue to drive higher. Nigeria's market up 20%, Kenya's market almost 30% gain. We have seen a bit of weakness in quarter two, but Ghana for 50% gain. What do you see as the key drivers of market activity right now, of the momentum we're seeing in Africa?
Well, you're absolutely right. The markets have performed really well so far this year on the back of strong performance last year as well. With regards to markets like Ghana, what's driving that is some very strong earnings coming in for full year 2012 for some of the major stocks in that market. Same thing can be said for Kenya and Nigeria as well. But it's not just the fundamentals that are driving that, it's also very positive sentiment. Globally, it is a risk-on appetite at the moment, so you are seeing a lot of global funds going into the Africa space. So
foreigners more and more investing on the African continent right now, more appetite for African exposure.
Absolutely, absolutely. Yeah. That is a component, and that does explain some of the positive moves in the markets that we're seeing so far.
I mean, returns is one thing, and I mean that's often what investors look at as returns. They say, well, if I had put some money in a specific market, I could have had some of these kind of returns. But probably more important to this, and especially for portfolio construction, is what benefit does an extra country or a sector add to your total portfolio construction? And to that tune, I'd like to show you the following graph. This comes courtesy of African Alliance, and what you're seeing is you're actually looking at a bunch of correlations for some world markets, and then you're looking at what is called global emerging markets, which is that one that you're seeing right over there, the S&P 500, and then you see some selected African economies at the bottom end of the screen over there. And what we're looking at is we're looking at how correlated these are. And if you have a look just at some of these numbers over here, you could see how little correlated some of these African markets are with some of the world markets. As a matter of fact, with the world, Egypt is only correlated by 0.26. That means for every 1% gain in the world, in world markets, Egypt is only going to go up by 0.26%.
And the other way around, of course.
Yeah, and the other way around. And I mean, I suppose that's one of the beauties here, Godfrey, is that you're actually getting diversification by putting money in Africa.
You're absolutely right, Cobie. In fact, what we try to stress is the long-term growth potential in these economies and these markets are substantial and they're real. But the real power, we think, comes also from the fact that if you combine it with a South African portfolio or a world or a globally diversified portfolio, you're also getting a lot of diversification benefits. So you have that upside, and on a risk-adjusted basis, the marginal contribution to your diversified portfolio is very positive if you're going to take some Africa risk.
What is your view on this as you see these graphs, Roland? Because as we're seeing here, I mean, Nigeria only correlated 0.15% with the rest of the world.
Yeah, look, a correlation of 0 means there's no relationship between the two variables, so it's clearly low. When I spent a number of years in Europe speaking to investors that wanted to invest in Africa, there was a huge interest in the growth potential that Africa is posing in terms of, there's a lot of a big population, and we're starting to see certain companies becoming much more formalized. The biggest detractor from investing or committing that capital were the kind of risks that you have to deal with when you're investing in Africa, and those range from sort of political to sovereign risks to currency risk to just basic kind of getting the data for companies in terms of corporate governance and getting share price data for long histories of share prices is quite tricky. So how do you, Godfrey, convince your clients, or how do you allay their fears with regard to those kind of risks? Because the returns look fantastic, right?
Well, if you're looking at risk, we don't look at risk in just one way. There are very many ways that we approach the idea of risk. If you're going to look at risk in one measure, let's say volatility, the standard deviation, the truth of the matter is the African markets in our investable universe are actually much less show much less volatility than one might expect from the outside looking in. So if you look from 2009 to 2012, October 2012, which is the last time we ran the data, your weekly standard deviation of returns is around 18% compared to 26% for, actually it's 29% for South Africa, or 20% for the S&P 500. Of course, individual countries can have more volatility, but again, if you have a diversified exposure, you don't just diversify away some of that volatility, you also diversify away some of that political risk. And as far as political risk is concerned, when it comes to corporate governance, if you've got, which is quite common in the space in terms of the listings that we look at, you've got a multinational subsidiary listed in a market in Africa, and some of that corporate governance, a lot of that corporate governance percolates down to the subsidiary level.
And of course, I mean, you know, Unilever, for example, in Nigeria stands out, Nestle in Nigeria. So anyway, there are lots of companies and examples like that in East Africa as well. So you're building an African portfolio. Where do you start? What's the starting point? And what was the starting point for the Pioneer Fund?
Well, it's a good question. For us, liquidity is it's not just a concern for investors, but it's a concern for us as well. We start by basically defining very clearly what the investable universe is, and we have some data to show with regards to that. If you look at the total primary listed securities or stocks on the continent, so we're not talking about offshore listings like resource companies on AIM or TSX or something like that, and also not including South African stocks with African exposure, ex-SA like an MTN for instance, just your primary listings, you're looking at a market cap in total, non-free float adjusted of about $112 billion. That's the value traded per day. And in terms of our investable universe, which is basically our hunting ground, a primary hunting ground, you're looking at maybe $100 million value traded a day, and that's adjusting for block trades over the last 6 months. Daily average. So the very first thing you need to decide is what's your space, what's your universe, where you're going to focus on in terms of where you're going to find opportunities.
Is it market cap or liquidity that is most important for you?
That's a good question, because you do get situations where, for instance, a Dangote cement with a market cap of $17 billion
rules the NSE pretty much on some days. On
a non-free float adjusted basis, absolutely. But if you look, that's about half the market cap of an MTN, for instance. But that stock will trade maybe $200,000 a day, whereas MTN will easily do 30 million plus. So you want to have a free float adjusted. But the way we look at it, we separate and segment the investable universe by liquidity buckets. So for us, large cap stocks are stocks that trade 500,000 a day or more. Mid cap stocks trade between 100,000 to 500,000. Small caps trade much less than that.
As a matter of fact, let's have a look at some of these stats. Have a look at the table that is on your screen at the moment, and it'll give you an indication exactly of how the African market is actually sliced and diced. And those are some of the numbers that Godfrey has actually spoken about just now. Look at that average 6 monthly daily trade at 112 million US dollars, and that's obviously for total, but investable comes down quite significantly. And when we talk about priority, down to 58.1. I mean, look at large cap, mid cap, and small cap. Godfrey, look at those numbers. What stands out there for you?
Well, for me, what stands out there is when we're talking about risk management, we are a bottom-up house, and but one thing that we understand is that you don't want to be overly exposed either in a country or a sector, and certainly also from a liquidity standpoint, you don't want to have too much exposure, for instance, in your small cap. So you must understand what kind of stock that you're investing in and how it relates to the rest of the universe. So if you look at our investable universe, which is like I said, our primary hunting ground, about 2/3 of that is large caps as we define it, then a third mid caps. You don't want to have too much exposure in your small cap segment, because that's when, if you have more exposure there compared to another fund, for instance, then you have potentially more liquidity risk.
So I mean, when you guys look at a specific country, you find, for instance, 1 or 2 or 3 counters that you could potentially invest in. Those would become part of the universe that you'd then be able to look at. And you do that for every single country in order to build a universe list that you can then do valuation on. Is that in principle how this works?
In principle, yes, but to give some more specificity to that, our total universe is just your primary listings on the continent. How we get to our main opportunity set or investable universe, we basically, because we're a bottom-up house, because we're valuation driven, we need to have conviction before anything goes into the portfolio. What do you need to get conviction? You need information. You need audited financials with notes, annual reports. You need to be able to speak to management, to meet management. It's not necessary, but it helps if you have analyst coverage. Certainly it also has to be within our circle of competence. If you take that total universe listing of 781 odd stocks and you eliminate those that don't fit the criteria that I just mentioned, you are left with your investable universe.
How much progress is being made when it comes to adhering to proper reporting standards? I know IFRS has been introduced in Nigeria now. So how much progress is made and where are the big kind of areas where there's still kind of issues for you, especially with regards to the countries that you would like to get more exposure to?
It's a good question. With regards to IFRS, like you mentioned, Nigeria, basically everyone has to report in IFRS, which means it's easier to make a like-for-like comparison with other markets within the continent. And again, if you are a global emerging market investor, not just the continent, but out globally as well. That's a huge improvement. That's just happened in 2012. In terms of areas of improvement, I would say if there's one thing, it's still the relationship between management and investors. There can always be improvement in terms of how much clarity. And the media.
I mean, at CNBC, we have results released on a certain day, and 2 weeks later, the CEO agrees to talk about them. You know, it's still that understanding of the immediacy of having the news.
Absolutely. But since the time I've been looking at these markets, there's been a huge improvement, and we expect to see more going forward.
Surely currency risk is one of the key things that you need to manage. Now, I understand that you've got diverse countries and therefore you diversify away that risk to some extent at continent level. But getting in and out of a country where, political risk could, scupper your transaction in terms of you're actually good at stock picking, but it gets wiped out by the currency fluctuations.
Well, the interesting thing with that, we've never actually seen that kind of scenario where you've had a wiped out in terms of your investment gains from a currency move. Ghana is a good example of where there has actually been quite a significant depreciation of that currency, and it will be not as bad, but it'll be worse than, but still, compared to South Africa, for instance, you could basically say the same thing. The rand has depreciated almost 20%. The truth of the matter is, for us, we're bottom up, and we don't make macro calls based on currency. We value companies, and if we have a very strong negative view on the currency, we will try and model and see how that affects the valuation of an individual stock. But in terms of diversification of that, if you have a diversified portfolio, the truth is you do diversify a lot of that fluctuation away.
So when you're doing this bottom-up approach, talk to us about the type of counters that you like. I mean, do you go for certain sectors? Do you go for a pan-African strategy? I mean, what are some of the criteria you look at for attractive companies?
Well, great management is a hugely important thing for us. Strategic advantages that are very difficult to replicate and also manifest in high returns. And then, of course, the valuation is critical.
So nothing new. I mean, there's nothing about African investing that is different to
I think that's a very important
approach.
point in terms of risk, in terms of diversification. These markets operate exactly the same way. It's just that a lot of funds have experience and other funds are new coming to the space. So some of that learning may come a little bit later, but ultimately the principle of the game is precisely the same.
You see, I mean, for me, classically, this is mispricing. So it's investment 101. If you apply the same rules which you apply absolutely anywhere in the globe. The only difference is here you're going to be able to get some mispriced, some seriously mispriced assets. And quite frankly, if you get those, you're able to get fantastic returns. And to show you maybe how fantastically mispriced this market can be, why don't you just have a look at the table on your screen at the moment. You'll see what the different benchmarks look like for the African market. So we're starting at the top at the MSCI, that's EFM Africa XSA, it's up at 41%, that's financial year 2012. Look at the S&P, that's the S&P Pan Africa, that's their answer to the African index, up 21.6. FTSE JSE, that's All Africa XSA, so that's not the South African index, up 30, and then Netbank All Africa plus 20.5. I mean, Godfrey, just have a look at those on the screen there. Those are massive divergence in performance for right across a whole bunch of benchmarks that all predominantly look at Africa. How do you choose a benchmark? How do you manage an environment like that?
Another good question, and the truth is there is no one benchmark that adequately represents the Africa space. If you look at the MSCI index, for instance, the challenges with that we have is that it's got a lot of concentration. So you will have, at some point last year, 50% of that construction was in Egypt. Egypt did 50% last year, and that's, drove a lot of that performance for that benchmark, which is great. But we don't think it's prudent to manage a portfolio with that kind of concentration, particularly on a risk management basis. And the concentration is something that a lot of other indices have. For instance, if you got the FTSE JSE or the JA30, also has a lot of concentration, particularly in North Africa. With the other indices, the S&P Pan Africa, for instance, or the Nedbank, the problem there is not necessarily concentration. It's more there's a long tail. You're looking at 186 stocks for the S&P Pan Africa, 100 stocks for the Nedbank. So you have a long tail. Again, we're a bottom-up investor, so we do a lot of work before we get to conviction. We don't think having a long tail like that makes a lot of sense. It doesn't make sense for us to put 20 bips of your portfolio in a particular stock that you spend a lot of time getting to conviction for. And as you mentioned, some of the costs are important, so not just the brokerage going in and out, but the FX as well. When you consider all that, even if you're right about your call, it's not going to move the needle. So that's the problem with those. But overall, when all is said and done, our opinion is probably that the Nedbank All Africa is probably the best index, but the biggest concern there is actually the fact that it's a price index. In our space, you see very strong dividend yields, 5%, sometimes much more than 5%, so a price index doesn't capture it, but it's certainly the best of a bad bunch.